Celsius stock fell by up to 10% after reporting earnings on November 6, 2024. And since then they have been tumbling down in price, and currently they are actually sitting at their 52-week low. So today we will evaluate why the company has fallen so much over the past month, and if it's just temporary and they are set to rebound in the next quarter. So first let's have a look at their earnings. They swung to a $557,000 loss from a profit of $70.4 million last year. Sales fell by 31% to $265.7 million, about $1 million below analyst projections, and the revenue from North America was down by 33% to $247.1 million, while the smaller international businesses posted a 37% growth to $18.6 million. PepsiCo's revenue contribution also fell by $123.9 million as a result of its inventory optimization efforts. So far it does seem like this quarter has been quite disastrous for them, except for the growth in the international businesses, which we will get back to a little later. Now jumping to the third quarter financial highlights, we can clearly see the revenue decrease from last year's third quarter, a decrease by 31% from $385 million to $266 million, which is the $123.9 million loss due to PepsiCo's revenue contribution decrease. Now the question is, did they really overstock, or did the demand for Celsius just slow down? It might be a mixture of both, but the main question is if this is just a one-time thing. So if we jump to our stock valuation spreadsheets, we can see that their revenue has actually been increasing at extremely high rates very steadily over the past 5 years. So a huge year-to-year decrease was quite unexpected, but so far looks like a one-time thing only. Now Celsius is the third largest energy drink company by sales right after Monster and Red Bull, with a 12.1% share of the world market. And if we have a look at Monster's price chart, as Red Bull is a privately traded company, we can see how well the biggest energy drink company has done over its lifetime. And as Celsius is the second biggest publicly traded energy drink company in the world, if all goes well, we might see it grow at the same rate as Monster Beverage. Celsius is actually growing at an extremely high speed. We can see their growth contribution to the energy drink market over the years, growing from 4.3% in 2020 to a whopping 37.2% in 2024. So they alone are growing the global energy drink market by more than a third. And they are also the highest growing company out of their competitors, as we can see right here. Now before carrying on, let's have a quick look at the 9 pillars, which are an essential tool we always use when analyzing a stock. First thing we can see after plugging in the ticker is something we quite dislike about Celsius, and that is their high P/E ratio. But if we jump to pillar number 1, we can actually see that their P/E ratio has been decreasing over the past 5 years. So if that keeps happening, Celsius might start trading more fairly to their earnings. Now regarding their growth, we already know that their revenue has been growing at extremely high rates, but if we jump to pillar number 4, we can see that their net income has also been growing very nicely, growing from 10 million in 2019 to 227 million in 2023. And regarding their free cash flow, that has also been growing from 1 million in 2019 to 124 million in 2023. So very nice growth across all 3 income fields. Now jumping to pillar number 6, where we have a look at the 5-year profit margin to be above 10. And we can see currently the profit margin is sitting at 49.59%. And if we jump back to the third quarter financial highlights, we can see that that has decreased by 440 basis points from the third quarter 2023, from 50.4% to only 46% in the third quarter of 2024. But we can see that the profit margin has actually been increasing over the past 5 years at a rate of 4.04%. So this slight decrease is something that doesn't bother us at all. Now moving to the shares outstanding. And normally in a situation where a company is presumably undervalued, we would expect them to be buying back shares at low price. But we can see that they are actually diluting them instead. But as they are a growing company, it is quite understandable that they need a decent amount of free cash flow to expand, which they are getting via selling out shares. Now we will skip pillar 8 as Celsius doesn't pay out any dividends and arrive straight to the final pillar, pillar number 9, where we will have a look at the long-term liabilities over the 5-year free cash flow to be below 5. And this is something we really like about the company. They have close to no debt, although they have been growing it quite rapidly over the past years at a rate of 201%. They still generate enough free cash flow to pay it off in about 1/4. So overall we can say that Celsius is looking very well with low debt and high growth. Now one extremely big driver for their growth is the increased sentiment to weight loss in the US, driven by zero sugar drinks such as themselves. And as obesity rates in the US are still high all over, there is a great market opportunity for Celsius that can drive their growth for the next many years. Also in 2024, they have expanded to 6 new countries, including Canada, the UK, Ireland, Australia, New Zealand, and France. So now they are officially a global company. But now let's get to calculating their intrinsic value. And first, as always, we will jump to the Graham's formula revised. And we will take the 5-year earnings per share, the base PE sitting at 7, the 5-year growth estimate, the growth rate multiplier, the average yield on AA corporation bonds, and the current yield on AA corporation bonds. And using the formula, we will arrive to an intrinsic value of $34.92, which is 26% or a quarter more than the current trading price. Now the second model we look to is the discounted cash flow model, where we take the free cash flow over the past 5 years and calculate the average growth rate to be sitting at negative 904%, but that is because their free cash flow is very skewed. So based on our research and the analyst growth rate projections, we will calculate the growth rate of 19% and using that predict the future free cash flow over the next 10 years. After that, we have to plug in the discount rate, and we have plugged that in at 7.7%, and using that, we will calculate the present value of that future free cash flow, which is the future free cash flow accounting for inflation. After that, we will sum all of that up, add any cash and cash equivalents, and subtract total debt to get an equity value, which we will divide by the shares outstanding and get an intrinsic value of $25.75, only slightly lower than the current trading price. And finally, arriving to the third valuation model, the multiples valuation model. And we have already compared Celsius to Monster Beverage and Red Bull, but as Red Bull isn't publicly traded, we will now compare Celsius only to Monster Beverage. So we will take the company's current trading price and calculate their earnings per share to get their PE ratio, which we will then multiply by the earnings per share of Celsius and get an intrinsic value of $24.59, slightly lower than the current trading price, showing us that compared to its competitor Monster, Celsius is fairly valued. Now we will skip the dividend discount model as Celsius doesn't pay out any dividends and arrive straight to the ultimate valuation, where we will average out the 3 valuation models we just did and get an intrinsic value of $28.42, which is 10.19% higher than the current trading price of $25.79. So if we plug in a margin of safety of 10%, we would get an acceptable buy price at $25.58. Now in our eyes, Celsius is looking like a fine company with high growth potential. They currently seem to be quite fairly valued, and so as long as the big miss this quarter was indeed only a one-time thing, they might be a good addition to our portfolio. And with that, if you did enjoy the video, if you found it helpful, make sure to leave a like and subscribe as it really helps us out.